You take 3,000 and divide it by 42, which has been, the average price ratio of the last 100 plus years. You get 71 and a half bucks. Divide it by 7 and you're almost to 400. That would be what it's coming out of the ground at. Silver Eagle premiums have been on the rise. That would be step number 2. I would say that the premiums are just about ready to start moving. They've moved up a little bit, but the tightness in the physical market in terms of secondary product, we've seen kind of a ceasing, if you will, of the sellback. So I would expect to see premiums really start to slowly and then maybe even gradually and faster move up as we get.
American multinational finance company JPMorgan has raised its price prediction for gold and silver. This is coming despite a price slump that has seen gold come down from new all-time highs and silver from a record 13-year high. In a note sent to clients, JPMorgan analysts said they remain structurally bullish on gold and silver over the medium term and see the ongoing consolidation in precious metals prices as a buying opportunity for long-term investors to further accumulate the metals. The analyst predicted an 8% to 10% upside for gold and silver prices into the end of the year, which would see both metals reach their targeted highs of $2,600 per ounce and $34 per ounce, respectively, in 2025. Bank of America analysts are slightly bullish on gold, which they predict will see a potential price surge within the next 12 to 18 months, reaching record highs of $3,000 per ounce. In their note, the analysts explained that gold reaching $3,000 is dependent on increased non-commercial demand, which they believe will be triggered by a rate cut announcement from the U.S. Federal Reserve. The analysts predict that this announcement could potentially lead to some market turmoil, which could, in turn, lead to inflows into physically backed gold ETFs and higher trading volumes. They also predict a rapid increase in central bank gold purchases, indicating potential opportunities for investors to capitalize on these market dynamics. Ongoing central bank purchases are also important, and a push to reduce the share of USD in foreign exchange portfolios will likely prompt more central bank gold buying, the analysts wrote. In a recent interview with Chris Marcus of Arcadia Economics, popular bullion dealer Andy Schectman examines the price predictions from JPMorgan and Bank of America, while sharing his predictions and expectations for both metals in the later part of the year. According to Andy, as we get closer to the November elections, a lot of events will occur that will wake people up to the reality of the US economy and financial markets and force everyone to seek shelter in safe haven assets like gold and silver. Andy expects prices to rise much higher than JP Morgan's estimates, particularly for silver, which he says could soon hit triple digits. We will present clips from Andy's interview with Arcadia Economics. Please share and like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks, and enjoy the video.
Everyone talks about the price of gold and silver and inflation and soft landing and all of the noise, but let's break it down and make it real simple. I mean, look, we're adding $1 trillion in debt every 100 days, and we have 150 trillion in unfunded liabilities. The national debt is up 11.5 trillion since 2020. And this is a country that has its fiscal house not in order. And when you look at the unfunded liabilities, who's going to pay for them? And, when the Congressional Budget Office says in 6 years, 100% of tax revenue goes just to pay mandatory entitlement and interest on the debt only, when you realize military spending is discretional, who's gonna fund our military? So we have a situation that is it's not. We can't continue down this path. Put it to you that way. And so I would just simply say that ultimately, gold and silver go higher in the face of a dollar that falls. And I don't know if it's gold and silver going higher as much as what JP Morgan is saying is that the dollar has to fall. And that's really what I think ultimately will happen. Now, when you look at what's happening around the globe, the de-dollarization, the de-treasurization, a growing union of countries, as we've talked about forever. And
de-treasurization, is that a new one?
De-treasurization, yes. Well, I mean, that's what they're doing. Why would anyone want to hold treasuries? You look at at gold, it's up 9.9% on average for 25 years. That's doubled the pace of the 10-year treasury. And we've proven to the world that we don't like what you're doing. We'll take your treasuries and might even give them to the country, or buy weapons with the proceeds and give to the country you're in a war with. That's a very tough thing to come back from. So I think ultimately it leads to more of the same. Countries seeking alternatives to the dollar, seeking alternatives to the treasury. Read Zoltan Pozsar. This is Bretton Woods 3, all about commodities. And it's also a country that has obligations that will be very difficult to meet just from tax revenue. So where are your options? Raise taxes, print money, and selling treasuries in an environment where there's only $8 trillion in treasury holdings that are foreign held. The majority of it is owed to us. Foreigners are not really keen. Now, there are some countries, if we are to believe that UK and Ireland and Cayman Islands are keen on holding our treasury debt, but the ones that have been responsible for funding our spending binge seem to be moving in another direction. So yeah, ultimately, I think those numbers might even prove to be low. Ultimately, gold and silver go higher in the face of obligations by this country that can really probably only be met through printing of money or monetization of bonds. Same thing, because just no one wants to hold our treasuries because of inflation risk, default risk, and outright confiscation risk. And I think that's really where it is in its simplest of terms. So yeah, I don't think we've seen anything yet, I guess, is the bottom line. And I'm happy with those numbers, but I would think that they could actually be much higher.
Well, then I will raise you a Bank of America. They're calling for 3,000 ants over the next 12 to 18 months. So does that fit your forecast a little better?
Yeah, I mean, it does. And I think that does. And then you take 3,000 and divide it by 42, which has been, the average price ratio of the last 100+ years. You get $71.50. Divide it by 7 and you're almost to 400. That would be what it's coming out of the ground at.
For years, Andy and other metals analysts, like Alasdair MacLeod, have warned about an impending endgame. Their warnings have become more urgent in recent years, particularly since central banks started dumping US treasuries and buying record amounts of gold for their reserves. In 2022 alone, global reserve banks purchased 1,136 tons of gold, the most since 1967, and the second highest amount since 1950, representing a 150% increase from 2021. According to the World Gold Council, the apex banks bought another 1,037.4 metric tons last year, marking the second highest annual purchase in history. The buying spree has continued in 2024, with China, India, and Turkey leading the way. According to the World Gold Council, central banks purchased a net 290 tons of gold in the first quarter of 2024, the strongest first quarter on record. With this trend expected to continue for the rest of the year, Andy says with a lot of certainty that we are much closer to the endgame than everyone realizes. Let's get back to the interview.
You look at the amount of gold that China's been accumulating, and we're only supposed to believe and producing that they have 26 or 2,700 metric tons. They have way more than that, and their banks are accumulating it and doing so in a manner that isn't reported to the IMF. Why would anyone tell the IMF exactly how much they have? And people have been saying China's been underreporting it forever. You look at like ICBC Bank and a few of the other state-owned banks. They buy gold as a proxy on behalf of the PBOC. They work at the refineries all around the world. They don't tell this to the IMF. It's not reported. Everyone always said China underreports. But now we're supposed to believe them, right? Alasdair MacLeod says, that they have 40,000 metric tons or thereabouts, 5 times what we do, and of which the state owns 20 and the people own 19. But I look at like India as an example of what's really happening. They bought 1.5 times the amount of gold in the first 4 months than they did in the entire year last year, but they repatriated 100 metric tons from the Bank of England, which by proxy is the London Bullion Metals Exchange. And all of these countries in Africa, including Saudi Arabia and Egypt have repatriated their gold from the New York Fed, i.e. the COMEX. So it's not only the accumulation by the most well-informed traders, it's also the repatriation, the removal of counterparty risk. And that's a lot, I think, what Zoltan Pozsar is talking about. That's why it's commodities. We've broken trust. And I think that's the most important thing. When the central banks say we're going to keep buying, sure, I would argue that the numbers that we all are led to believe are way underreported. The IMF says that. The analysts at Bank of Montreal says that. And everyone has said that about China in particular for years, going back as far as I can remember. So I would simply say that there is no reason for gold to have been reclassified tier one. And when you see, other than that, it's significant in terms of where it's going. And when I say gold, silver is part of gold. And as one goes, so too will the other ultimately, for different reasons now. But they're not going, one's not going to the heavens without the other one coming with. But I think when you see the repatriation, it speaks volumes. It's about the loss of trust. This is what it's all about, the loss of trust. And can you put Humpty Dumpty back together? Don't know. The trust is something that I think is very difficult to get back once you break it in any form of life, whether it be relationships or, in this case, the world reserve status or the center of free trade. People look at this country differently now in many ways. And I think, maybe the most important way is the risk of having assets in treasuries as savings. Instead, they're looking at commodities, which I think have no counterparty risk, and the relevance of how important they are. The central banks say that, and I would argue that they're buying way more than they're telling us and producing more than they're telling us. So, tell us just enough to keep us interested. But if we really knew how much the Chinese were buying or any of these countries, the price would go parabolic. And it's in all of their best interest during the accumulation phase to be tight-lipped about that and not be genuine. Doesn't do them any good to do that.
According to the World Gold Council's 2024 Central Bank Gold Reserve Survey, 29% of respondents said they plan to buy more gold for their reserves in the next 12 months. This is the highest number of respondents that have said this since the WGC started conducting the poll in 2018. The council revealed that the respondents said they plan to buy more gold due to a desire to rebalance to a more preferred strategic level of gold holdings, domestic gold production, and financial market concerns, including higher crisis risks and rising inflation. This is no coincidence. We are witnessing a shift that will reverberate through the entire global financial system and change how the game is played. Do you agree with Andy Schectman's analysis of the current situation in the gold and silver market? Please share your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos on gold, silver, and other metals and commodities. Thanks for watching.